All right, it is time for our panel, and this is on blockchain, a term I'd only just recently heard of, and now I seem to hear about it all the time. This panel is going to delve into the nitty-gritty. Far too complex for me to oversee this one, though, so I'm going to hand you over to Andrew Weaver, who is a consultant at Legacy Consulting. He'll be facilitating this panel. So the panellists, if we could get you up on the stage when you're mic'd up and ready, and over to you, Andrew.
I'm Andrew Weaver. I've been doing payments for 30 years. I started, believe it or not, I don't look that old, right? I started as a trainee COBOL program with the National Bank back in 1987. I've been doing this for a long time. Now, and what's really interesting, what I've really found is that a lot of the innovation that we have seen as bankers, and I do consider myself a banker in that context, has been innovation on top of the existing infrastructure and the existing rails. That's a term that's used a lot. Now, what we're talking about here with blockchain is actually a completely different infrastructure, and in fact, the rails are gone completely in some cases. So there's a whole lot of new stuff that we're dealing with here. Now, with that new stuff comes a whole lot of misconceptions. It comes a whole lot of misunderstanding, a fair bit of fear in some cases, a bit of mistrust in other cases, and certainly a whole lot of miseducation going on around the place. So one of the things we're going to be doing today, I guess the theme of the panel, one is a little bit of education in terms of helping everybody here understand what the different applications and uses of blockchain are and how it relates to Bitcoin as well. We're going to be talking about the different applications, potential applications, which are way wider than most of us probably even consider. And we're also going to talk about the regulatory aspect as well. So how do you deal with a beast like this that's coming in and potentially disrupting, but potentially augmenting as well? So there's lots of different considerations. We have a very auspicious panel with us. So we have Katie Williams here from Buddle, Findlay. She's been working in the payment scene. Most of you probably know her or have seen her before, and has a particular interest in this space, probably by accident as much as anything else as a starting point. But yeah, really delving into some of the complexities of the regulatory environment. We have Fran Strajnar, if I get that right. Sometimes Fran's Steinlager, apparently, but that's a different story, I understand. Fran, he is the CEO and founder, indeed, of Brave New Coin. Very much in the entrepreneurial space. He will talk your ear off, as apparently he was to some people at 3 o'clock this morning, about geopolitics and TPPA. That's where you go? Yep. Yeah, we're not going to go quite there in this discussion, but we'll get somewhere close to it. Then we have Richard Miller. Richard looks slightly different than he does in the photo, if you notice. Here you go. He is doing Movember and keeping his options open, apparently. This is the story. So Richard is with Deloitte and looks after, there's quite a big practice that you've got that is taking an increasing focus in the distributed ledger in the blockchain world. Next we have John Rout. Now, John, you hear a lot of things about Bitcoin and sort of the shady underworld. John deals with some of those people in the shady underworld. They're called the Australian Stock Exchange. And it's dealing with the distributed ledger capabilities and settlement capabilities. And so he's part of the digital asset. He's head of product for digital asset. So it's quite a different application, and we'll have some interesting points to raise. And last but not least, we have Stephen Macaskill. He is the president of the Blockchain Association of New Zealand. So obviously an early adopter, but also a voice for the blockchain community in New Zealand. Now what we're going to do, we're going to start off bearing in mind that there is a lot of misconception out there and a need to, I guess, clarify some terminology that gets thrown around. And just raise a level of awareness. So we're going to start off, each of the panellists is going to have a minute where they're going to talk a little bit about some key points that they'd like you to take away from today. Then we're going to get into the questions. So we're going to start off with Fran.
Perfect. I set up bravenewcoin.com to help track what's going on in this industry. We're the largest curated library of research anywhere online. You can feel free to find out all the news and analytics. Just to paint some context into what's really sort of gone on in the last few years, with the advent of Bitcoin, we effectively saw a dematerialization or a digitization of currency. And seeing, as that's become highly popular and successful, we're now seeing blockchains created because of a very low cost barrier to entry for a range of other asset classes and applications. So it's gone from currencies to physical stores of gold and other commodities to various different securities, and there's a lot of confusion in terms of the terminology and taxonomy, which is something that we're working on. So we just broadly label it into either digital currencies, which you can use and spend like a normal currency, or digital assets, which represent some form of value, and you use the blockchain to transfer that value. And when it comes to blockchains, which is the underpinning technology behind Bitcoin and all the other digital currencies, we simply break that down into two different categories. Either they have a token that is tradable, which is the incentive for all the different nodes and people to participate, or it's a tokenless blockchain, and we simply call that distributed ledger technology. And that saves a lot of confusion. So blockchains typically come with tokens. Distributed ledgers use the concept of a distributed ledger system, but do not require a token component.
Cool, thank you. Richard's going to follow on from that.
Yeah, so we've done a lot of work in this space, creating over 35 proof of concepts and having 300 to 400 practitioners around the world now involved in distributed ledger technology / blockchain. So we do think that it has the potential to fundamentally transform certain parts of our economy. The question is, though, that it's going to be likely a lot more focused than some of the hype out there. So the key message that I would want to leave you with is that there's a lot of situations where you could use blockchain, but far fewer where you should. So if the distributed nature of the ledger, for example, enables a P2P transaction in a space that's otherwise very complex, that creates value. So cross-border payments, and potentially is an interesting application. If the combination of an asset register with a transaction mechanism creates value, as in potentially in post-trade settlement, that creates value and is of interest. But fundamentally, it actually needs to fix a problem. What the current system has to be somehow sub-optimized or broken for it to create value. And I think that is where a lot of people are trying to apply blockchain in situations where actually there isn't anything fundamentally broken. So lots of situations where it could be applied, but far fewer where it should be.
Right, and we're going to push in a little bit on that in the first series of questions. John?
I think just to build on Richard's point, it is absolutely crucial that you think about what is the actual customer need when you're thinking about the technology. Technology is interesting for technology's sake, but you need to focus in on what is your actual challenge here. And for us, digital asset is completely focused on post-trade clearing and settlement. As was mentioned, we're working with the Australian Stock Exchange and a number of other exchanges around the world, including the DTCC and SIX in Switzerland. But specifically for us, the problem statement that we're looking at is effectively a synchronization problem. If you think about a single trade, you've got a buyer and a seller, but the buyer and the seller trade via brokers, and those brokers in turn clear via clearing and settlement participants, who then are members of an exchange. After an individual trade or an execution has gone through, all of these participants' only mechanism for staying in sync with one another is by firing messages at each other and hoping that those point-to-point messages reconcile. If they don't, there's a very manual and expensive process to get things back in line. What distributed ledger technology offers is the potential to keep everybody in sync with the golden source of truth at all points in time. And that, while perhaps less exciting than all of the hyped up views on blockchain that you read, is a very meaningful and serious benefit to those participants in the post-trade market.
Cool. Thank you. Stephen?
If you look at the history of banks, for most of their history, they were able to create their own competing currencies. And it wasn't until recently that banks were no longer able to compete on that level. And when they lost the ability to do that, they lost their ability to innovate. And that didn't stop innovation, and that's the reason why we saw this rise of cryptocurrencies. And if you look at the technology, it's still in beta, but as a beta technology, it has the largest blockchain has transacted $100 billion of value over the last 7 years, and is now the largest distributed computing network in the world, tens, if not hundreds of times larger than all of Google's and Amazon's computers combined. And when you start looking at the hype behind blockchain technology, I think what you're really seeing is something that isn't unwarranted. It is seeing that blockchain is a symbol for the age of decentralization. And the blockchain technology is enabling new systems of decentralization that are focusing on corporate structures, information, and various government structures. And so the technology is enabling us to have things like decentralized social media networks, decentralized stock exchanges, decentralized ride sharing and e-commerce that operate 24/7 and are larger than any one sovereign location. So they're technology protocols that are outside of different jurisdictions. And this isn't a futuristic world. These are technologies that are here today, that are in beta, and that people are pouring hundreds of millions of dollars in. And right now the market's at $20 billion, but it's growing every day. So blockchain technology is definitely its current iteration needs a lot of improvement, but as it improves, it's going to grow to, in that beta, to service billions of people globally. So,
Cool, thank you. And that's a great introduction on the possibilities into Katie, who deals with the regulations and the implications of that.
Yeah, absolutely. I guess unsurprisingly, as a lawyer, we're quite interested in what the regulation could be or should be with this new technology. And I think particularly in the financial services context, having no regulation apply to whatever activities people are using this for is just not going to be an option. Financial services regulation is really about consumer protection and maintaining the confidence of the consumer in the system so that they'll keep their money in the system. And if we go to new technology where there's none of that protection, people are going to be a lot more reluctant. But at the same time, we don't really know where this is going to go, and we don't really know what the possibilities are, and you don't want the regulation to go over the top and stop innovation and stop people trying new things or make it too difficult for new entrants, particularly the smaller entities and startups, to get in the market.
Cool, thank you. Just going to get into the questions before. The tech guys, can you put the time remaining left on the big screen so we can see it? Can't see the other one from here. Thank you. So we talked a little bit about use cases and application, and I think this could go anywhere, but I'm thinking that perhaps what we can do is, from each of your perspectives, what you see some of the actual uses, some of the best examples of how to make this technology work and where the opportunities are for an audience such as this. So perhaps, Stephen, if we start with you and come back down this way.
Sure, yeah. I think a great use case currently are remittance markets and crowdfunding. So in some Filipino remittance markets, in the last year, Bitcoin businesses have captured something like 40% of those markets. And in addition to that, a lot of businesses are using cryptocurrencies to bootstrap their new business models in this decentralized age. And hundreds of millions of dollars have been raised over the last 6 months around these new business models.
I'd obviously say post-trade clearing and settlement, mainly because that's our focus, but there's a number of issues that mean that this is the right cab to be going off the rank next. The first is that a lot of exchanges around the world are still running COBOL systems from 30 years ago that are due for a replacement. The second is that a lot of markets around the world are on a continuous path towards dematerialisation. The Australian-New Zealand market are already there, but that is a trend that is continuing globally. And also, banks and entities that are trading in these markets are subject to growing cost pressures and increasing regulatory demands that seem to change from year to year. And it's increasingly more difficult to make changes and amendments to the existing systems. The result is that it opens the door for an opportunity if you apply distributed ledger technology in the right way. And the key thing to take away, I'd say, is that you don't need to look at distributed ledger technology as a one-size-fits-all option. I'd like to think of it more as a bit of a menu of technologies that you can choose and apply from, subject to what is the particular problem that you're solving and what are the constraints that you need to protect. For example, in clearing and settlement, it's absolutely crucial that privacy and confidentiality of trading information is not shared between entities. And so with a clever application of the various components of the distributed ledger technology suite, you can solve while ensuring that privacy and confidentiality are maintained.
Yeah, look, I'd like to pick up on the remittance one again. I think that, as was mentioned yesterday, cross-border payments is certainly an example where there is a pain point. It's slow, it's expensive, it's not transparent, and it's a poor customer experience. So it's also worth noting that the only use case for blockchain that has been in production and is operating at scale is Bitcoin, ultimately a payments use case. And I think the reason it's so popular is because it gets beyond the problem that we have right now, where all our clearing and settlement systems have grown up in domestic environments, and linking them together as being a continuing challenge. So Bitcoin allows you, or any blockchain-based mechanism where you can move a value token from one place to another, allows you to circumvent that and to disrupt the correspondent banking system. The challenge, or challenges, sorry, there's two of them, is that on either side of that transaction, you need to be able to convert that digital token into value that you can actually use in the real economy, because most people still spend real dollars, real fiat currency in their individual countries rather than depending on digital currency. Associated with that is the challenge of actually dealing with compliance on either side. So anybody in payments obviously is very familiar with AML, KYC, CTF obligations. And so one of the core elements or challenges is how do you deal with that on either side? So to John's point, actually, I think that the answer lies in combining technologies. So if you can move the value from one place to another via digital currency or a digital token, you can potentially then hook into existing systems or existing commercial arrangements to deal with or take care of the compliance requirement. Visa just launched an interesting proposition called B2B Connect that leverages their existing relationships with 17,000 plus institutions around the world with the transfer of value via a blockchain-based technology. So I think that as this evolves and as we learn more, as we experiment more, we'll see a lot of interesting ways of putting together the technologies to actually address some of the challenges that the technology itself doesn't fully.
That's awesome, and we'll come back to that and explore that thought a little bit further as we go. But just
right. Well, what I'm seeing is kind of a two tracks. One, there's a full-blown new asset class. It's trading billions of dollars a week now, and the reason for that is once you dematerialize value, you have you just remove all friction. You can do things like create a much smoother remittance markets, but you can also unlock value that is conventionally locked in. For example, I know of several projects looking to release brand equity and intellectual property and physical property, commercial property, which is conventionally very difficult to liquidate if need be. So tokenization through a blockchain allows for unlocking value that is typically locked up in a intangible or a physical form. And that's the side that I'm personally excited about, and what you can do by layering in intelligence and programmability on top of a digital asset class. On the other side of things is the actual blockchain technology. I see what Digital Asset Holdings is looking to do with post-trade settlement. I also think there's going to be a sort of pre-trade solutions brought to the market as well. This touches on what I just said, but I really want to see a secondary market for crowd-funded companies. So when I go and buy, 10 grand worth of that brewing company because I think, I'll give it a punt. If I get hit by a bus tomorrow, I can't sell that. So I have to wait for liquidity events. If that was expressed through a token for a secondary market, all of a sudden it expands the range of possibilities. But every single blockchain solution design that I've looked at typically has a stumbling block, and that is the identity management component, right? So to bring this asset class and this technology into the real world under business and rules and regulation, you need a strong identity solutions. I'll leave it at that.
Yeah, that's great.
Yeah, I guess probably not too much to add to what's been said before. I think, the main things we're seeing in financial services is where it's being used, where there's, a lot of intermediaries involved, or where it's slow or it's uncertain, and there's like a real friction that can actually be solved by bringing in this new technology. So things like trade finance, where there's a lot of documentation and it's got to be, sent in paper form around the world. Things like that can be really, made more efficient by some of this technology, and obviously settlement and clearing and some of those cross-border payments where there's a lot of, it's slow and you don't know how much you're paying and you don't know when it's going to get there, and people want certainty.
Great, thank you. Now, just exploring that a little bit further, there were a couple of statements that were made there. One, and Stephen, you have an interesting point, and you're consistent on this, that you will talk about the technology as being in beta, and you'll talk about it as being in beta for the foreseeable future, right? And then we're talking about use cases, we're talking about collaboration, we're talking about fixing the pain points, that sort of stuff. And it's sounding like one of the other terms that got thrown around yesterday was a sandpit, was the ability to create an environment, not just a technology environment, but a business environment and a regulatory environment that can foster the actual refining of these solutions and the technology and the application of the technology as we move forward in this. So, Fran, I know you've got some particular thoughts on this type of subject, dear to your heart.
Well, to shamelessly self-promote, we're proud to say that we've just created a joint venture called Blockchain Labs here in New Zealand, where we are able to give enterprise government, large organisations that want to do rapid prototyping or business analysis and model validation or invalidation work, the expertise and resources required to basically explore blockchain deeper than they currently do in-house. You read about it, Australian counterparts seem to be doing a lot more. I think New Zealand needs a sandbox environment to at least experiment, and that's what Blockchain Labs is designed to do.
Stephen, perhaps jump straight to you as the association president. What are your thoughts on what we need, and what have you seen around the world that works?
Well, I think, so going a little bit back to the beta, I think the World Economic Forum predicts that $10 trillion of global value, or 10% of global GDP, will reside on blockchains by 2027. And I think that the technology is still going to be in beta when $10 trillion are residing on those platforms. So I think that it's okay to jump into using this technology and look at how it's being used in other ways. For example, there is a social media network launched 6 months ago that now has 150,000 users on it, and it's a blockchain-based social media network. You can only get into these different projects through cryptocurrencies like Bitcoin and Ethereum. So I recommend buying $5 worth of any cryptocurrency you can find, play with it, understand how it works, and because that is going to be the future. And There are 3 billion people out there without identities, without bank accounts, but they have smartphones. And so you have to really question, are banks the horse and buggy of finance?
There's a good question for the crowd, right? Richard.
Well, I was just going to build on that, and then we had that nice line there. I think it's important to remember, right, that the internet took decades to come into its own. And we've only had blockchain around for 7 or so years, and most of us have only really been looking at it seriously for a couple of years. So there is a lot of learning, a lot of development from just understanding the technology better and how it plugs into other technologies that we already have in place. There's, though, the standards and the regulations and the rules, too, that I think we need to spend a fair bit of time defining. Right? So defining TCP/IP really helped pave the way for the internet. There's a range of similar types of definitional activities that we need to.
We had OSI, and a lot of governments, a lot of enterprise got behind, but TCP/IP is what won out. So this is what I keep telling people. You know, the standards and protocols are still evolving today.
Yep.
Microsoft wanted their own internet. Oracle wanted their own internets. You know, front cover of PC World had, do you have an intranet strategy? That's very similar to what's going on today, where there's no clear winner.
Okay.
I suppose I might also just build on that to say that the public blockchains, by virtue of the mechanisms by which they were created, tend to have core groups of developers, and progress and adaptation of the underlying technology requires agreement amongst these core groups of developers. One of the benefits to private blockchains or private distributed ledgers, similar to what DA is working on together with the ASX, is that you can sit down with a customer and understand their requirements and then work to adapt the technology and iterate very rapidly so it can grow and improve quickly. And I think that when you take the example of the early days of the internet, there were very few people on it. So that as they were doing that sort of experimentation and formalising these standards, it was much more possible than it would be if there is a large group that needs to all be kept happy with economic incentives.
Okay. Katie, what are your thoughts on this?
Yeah, I mean, I think, to Richard's point, we sort of need some of the regulation to keep up for it to progress and move forward faster. I think there's uncertainty at the moment about what regulation's going to be and how that's going to fit, and so people are sort of a bit, I guess, you've got businesses where they don't have, clear regulation that applies, and they're not sure if consumers are going to be comfortable using it. You've got consumers who don't know, if they're going to have the protections that they'd have through a normal system, and then you've got regulators who, not much of it's really happening kind of actually out there in the mainstream, so there's not really any sort of push on them to actually deal with it quickly, and so sort of at some point one of those is going to have to go first. And
yeah, and that's a really good question. I do want to pose that one specifically. So in order for this to move forward in the New Zealand context, in the New Zealand environment, I guess 2 questions for each of you as stakeholders. What do you need from the traditional payments industry, and what does the traditional payments industry need from you? So perhaps, Richard, you sort of sit in the middle to an extent. You could start with that one and see where you go.
Look, I think that what I encourage anybody who's got even a passing interest in payments and a specific interest in blockchain to do is to just have a go, to start to wade into understanding how it works, its different flavors, the issues associated with actually developing a proof of concept or a use case. So I think openness and perhaps some leadership amongst both the New Zealand but also the global payments community, I think will be a useful thing. Right? Payments, I think, has always been a team sport, and almost by definition, a distributed ledger-based system also requires a number of counterparties to agree to collaborate. So I think the payments industry is there's a natural home, both from a utility perspective, but both because there's a tradition of collaboration.
Cool. Stephen, you made the horse and buggy comment, which is a good comment. So if traditional payments is the horse and buggy, how do you work with the horse and do you put TO charges on it? What do you do?
Well, I don't think you put a horse, in front of a car chassis, if that's what you're asking. But I think a good way of looking at it is comparing it to another standard like the English language. And blockchain, it's a technology, it's a protocol. The English language is a protocol. There's no regulatory oversight over the English language. It's greater than any one jurisdiction. Same thing with technology protocol. It is constantly evolving, and it will look very different tomorrow or a year from now than what it looks like today. And it evolves to meet the needs of our constantly changing world of commerce and trade and globalization. So understanding that this technology that resides on mathematics is something that is going to evolve and is going to change to meet our needs. And with that, there are going to be competing standards. And it's really a matter of time to find out which ones are going to serve us the best. And I think that it's really important, as Richard said, that we work and understand and just dive into it and test it and play with it, because you're not going to be adopting it and using it. Everyone else will be if you're not diving into it and using it.
So, Fran, if you had 10 minutes with a senior banker in the room, what would you be asking them?
All sorts of fun things. What I'd like to bring it back to is when the internet arose, we had basically the protocol level represented this much, and everything else was an application on top. Okay, so this is from browsers to the cell phones that we have today and all the rest. Blockchain's inverted. The protocol level is the biggest piece. The application's built on that. Think of it as mycelium, right? You'll have this huge network of nutrient exchange on the ground and various little mushrooms popping up here and there. I want to see more development to the protocol level, because that will strengthen the quality of the applications that will arise. And I'd be asking bankers not what's your blockchain strategy, but what's your strategy in a world that is interconnected in terms of data sharing like you've never seen before?
Okay. Katie, it's probably a good one for you to jump straight into.
Yeah, sure. I think something that's probably been quite hard to date, particularly from people we've talked to and specifically sort of around Bitcoin, is like we've sort of discussed, in order to actually transact within it, you actually need to get money in and out of the system. And I think particularly with anti-money laundering requirements and regulations, a lot of the banks are a bit uncomfortable or uncertain about banking people who are providing exchanges or wallets or anything really Bitcoin related. I don't think, it's known for being, a bit anonymous, and how do you know where the money's coming from? And it's got, traditionally some sort of reputation for being used, online for drugs and that kind of thing. And so I think a lot of accounts are being closed, and I think getting some better understanding between, I guess, the startups and the people who are wanting to use accounts for this, and then also the bankers, and trying to find a way where the bankers feel comfortable and like they're not going to be breaching their obligations, but to still open up that market.
So most regulatory considerations come into the currency sides, the blockchain. And especially when there's on and off ramps like Katie's talking about. New Zealand's been a complete grey area. I think I was your first client on Bitcoin, by the way.
You were.
So I imported a bunch of ATM machines, and it just fell into the hard basket. I sold them to a guy in Sacramento. And the reason for that is that New Zealand's just kind of, we don't see the demand, but we don't know what it is, so we'll shut your bank account down in the process, I mean, I would love to see a proper exchange here, because that will act as a remittance node and a remittance network, and sort of has a whole range of other possibilities that could be done out of it, but we need regulatory clarity. I've never worked in an industry that's dying to be regulated. Just give us the rules so we can get on with business. Right?
Yeah. John, you've probably experienced some of this because you mentioned you're dealing with the regulator as well as the stock exchange, right?
Very much, and I suppose I just second the point that we made earlier that distributed ledger technology does not need to be mutually exclusive with the current regulations. What I'd like people to do is take a chance, have a go, have a bit of a play with the technology and understand the nuances and the options that are available to you so that you can run your business as you run it today, only more efficiently, whilst also being subject to the same sorts of regulations that you are today. It doesn't require a wholesale change of the system to leverage some of the benefits, some of the most important benefits, which for us is really that synchronisation between multiple parties in a network.
Cool. I'm conscious we've got about 5 minutes left. We do have some more questions prepared, but conscious of opening it up to the audience as well. So there are a few hands. So have we got a mic there? David.
Thanks. Yeah, I've got two questions. So the first one is, why is frictionless good? You kept going on about frictionless, but it strikes me that a system where grandma gets an email, she clicks on the wrong link, and now her house belongs to somebody in Minsk is not necessarily an optimal. So I think you need to explain why frictionless is good, because it's not transparently obvious. And secondly, in the only practical example that was discussed on the panel, which was the Australian Stock Exchange, you said a couple of times distributed ledger to make the point that it's not a blockchain. But I didn't quite understand who has the copies of the ledger and what is the consensus protocol for reconciling between them.
So it sounds like, Fran, perhaps if you can deal with the first question, and Stephen, you might have something on this as well.
Just trying to remember what subject.
The house in Minsk.
The house in Minsk, okay, right. That's far too frictionless, and I don't see that happening because there's too many parties involved. And if we're going to do a title transfer, it's got to be some kind of multi-signature environment to ensure it's being transferred from the right person to the right person, from the correct parties. I don't see asset registrars moving to a blockchain in the Western world anytime soon, for one. But what I'd like to see the friction removed out of is, like the crowdfunding was one example.
Just use money then. What happens if grandma accidentally presses the wrong button in some stupid email and sends her life savings to Minsk? What are you going to do to get them back? Why is frictionless good? You need to explain that.
Frictionless in the context of unlocking things that are currently bottled up, such as, the example of, I can't sell the equity that I bought into a crowd-funded campaign. I view that as friction. I would like to remove that friction to be able to have better liquidity in assets that are otherwise currently illiquid.
So let me just step on, I think on this one. Frictionless is not the outcome. It's less friction. Right? So situations where there is a lot of currently low value adding friction, I would again point to the correspondent banking system. There is the possibility to remove a lot of that, remove the cost, and make it a lot faster. Blockchain is certainly not necessarily the only way to do it, but it seems to be an attractive one. You still need the authorization and authentication mechanisms on either side of that to make sure that regardless of what technology you're using to affect value transfer, be it blockchain or instant payments, they still need to, the in and the out side of the value transfer still needs to be managed effectively.
And I think too, in this as well, we dealt with right at the beginning the different, we need a problem to solve, right? It's not the panacea for all problems. We're not going to replace banking with blockchain and Bitcoin. Not today, anyway.
Well, okay, so what we're seeing now, what you're saying is what we're seeing now. Nigerian princes sending emails to grandma, and grandma's just going to the bank to send $10,000. I mean, that's something that happens now.
Yes, you're true. That is right.
Should we go to the stock exchange question?
Yes.
That one's going to be fun. So as far as the stock exchange is concerned, I mentioned that distributed ledger technology is something of a menu. And Digital Asset has recently published a white paper on our global synchronization log. So the first thing that you need to say is that the distributed ledger, the global data store that is shared amongst all participants in that network, which in the Australian case is the same participants that are permissioned to be part of that private network today, the same people that participate in the messaging network. And what this, the data store on the global synchronization log serves to do is keep all of those participants in sync without disclosing the private and confidential information. The second thing, as far as consensus is concerned, there is the potential for a consensus algorithm to be built on top of it, but at the moment, the Australian Stock Exchange, much as the New Zealand Stock Exchange, is the principal person responsible, or the principal entity responsible for maintaining that global source of truth. And there's no reason for that to change. You can synchronise lots of people's access to a readable global data store without necessarily having to distribute the capacity to write to that network. And this is one of those menus of choices that I was talking about. You get the benefits of synchronisation without the complexities of consensus. Because what it allows you is certainty that your data is completely in sync with everybody else.
Cut this particular bit off, and I appreciate the questions, David. We have pretty much run out of time. We do have a burning question from Sam over here. Perhaps if we can get one of the panel to pick this one up.
No, it's not a question actually. I was just letting people know, because you guys have been saying that if, you know, what you should do is experiment a little to try and get an understanding of how the technology works. I've got free Bitcoin on me. I'm giving it out to people. So if you really want to, you know, try Bitcoin for yourself on your phone, just come and see me and I'll show you how to set up a wallet. I'll give you a bit of Bitcoin and you can practice sending it around and getting a feel for how it works.
And I think on a personal level, great. There's a good opportunity there. We've also heard from the panel that this idea of collaboration and cooperation, and certainly more education. Perhaps if I could ask Katie, putting you on the spot, what do you think we should do next in this environment with this audience?
I think it's kind of what you've just said, really. It's for people to go away and experiment and try things. And I think unless companies start actually giving it a go and trialing it and looking for opportunities to use it, we're not going to learn how it can be used or how it should be used or what's even possible.
Great. Thank you. And thank you all the panellists. Appreciate that. Handing back to you, Nadine.
Thank you very much, Andrew. A very lively panel, and as is evidenced by most of the delegates, I think, at today's conference, being in this breakout stream, people are very much focused on learning more about blockchain. It's now after 12, which I understand means the polls are starting to close in the States. So I think it also means it's time for lunch. So let's go have a bite, and the results will start rolling in this afternoon. We'll see you back here at 1:20.